Okay, in Chapter 6, we learned how managers and the cost accounting folks put together our budgets and how managers use those budgets to aid them in their planning and directing functions. Here in Chapter 7, we are going to take a look at how to develop a flexible budget and how we can calculate what are called variances. We're going to be looking at the direct cost variances in Chapter 7. We will look at some other variances in Chapter 8. And we're going to learn how to use those to help us in our management control functions. So our learning objectives for Chapter 7 are, number 1, to understand static budgets and static budget variances. Number 2, how to examine the concept of a flexible budget and learn how to develop it. Number 3, calculate flexible budget variances and sales volume variances. Number 4, explain why standard costs are often used in variance analysis. Number 5, how to compute price variances and efficiency variances for direct cost categories. Number 6, understand how managers use variances. And 7, describe benchmarking and explain its role in cost management. All right, so we've got some basic concepts that we need to have down pat for mastering our material in Chapter 7. The first one is the word variance. And variance is basically just for us to calculate a difference between actual results and expected or budgeted performance. Okay, so we are going to be taking actual quantities and we are going to be multiplying them times actual revenues and actual cost in order to get a total for actual results. And we're going to be comparing those to expected totals. Okay, so we're going to be using budgeted or expected per our original plan, and we're going to be taking these numbers and doing some calculations and then figuring the difference between the two. What were the actual results and what were the expected or budgeted or planned results? And we're going to calculate those differences and figure out why there were those variances. Management by exception is a concept that is practiced quite frequently. Basically what it does is we go and we do the variance analysis and we focus our attention on areas that are not operating as expected or as budgeted. Now, this can be either a good variance needing some investigation so that we can share this information with our other facilities. Maybe it's a really great practice that's been instituted and we need to train some more employees on how to do that great thing in order to continue with those efficiency and improvement gains. Or if it's a negative or unfavorable variance, we need to figure out how we can curtail that going forward. Okay, so management by exception focuses on what is going on and not operating as expected. The static master budget is what we learned how to put together in Chapter 6. Okay, so again, the static or master budget is what we learned how to put together in Chapter 6. And it is based on the output that we have planned for the period when we're putting this budget together. So static master budget. You're going to hear me repeat that over and over again because I want you guys to focus on what that static master budget was. It was our plan from the beginning of the period, what management wanted us to be able to pull off. It's going to be revenues per unit selling price and a specific number of units to be sold. And those specific units would have underlying cost in relation to direct materials and direct labor and our overhead costs that go into making those products or providing that service. And we had a specific dollar amount for those types of costs planned based on the quantity of inputs necessary per unit and what we expected those units to cost us each. Okay, so we used standard costing. Standard amount of quantity per unit times a standard cost. And that's how we developed that master static budget. So make sure you've got that point right there down pat before we go in and start developing what is called our flexible budget, and also comparing both of those, the master static budget and the flexible budget, to our actual results. All right, so we can calculate first off what is called the static budget variances. Now, I really want you guys to pay attention to the terminology used in Chapter 7 and Chapter 8. Again, we have definitely got it down pat by now that accounting is the language of business, and it's not so much the math that's the difficult part. It is paying attention to what the words mean. Okay, so this very first one right here, static budget variance, is going to be a calculation, and it is going to give us the difference between the actual result, okay, what actually ends up happening during the period, and the corresponding static budget amount, or what was originally planned in the master static budget. Okay, so how do we do this? We put the master static budget together prior to the period. It is our plan. We expect so much in revenues. We expect so much in costs and expenses, and we expect a resulting income at the end of the period. The actual results are our actual revenues and our actual costs and expenses and our actual resulting income at the end of the period. We're going to compare those two. The difference between the actual results and the master static budget gives us the static budget variance. This is the macro level. This is the top of the line. We are then going to be able to take the static budget variance and break it down into a multitude of other items. If we have what is called a favorable variance, it has the effect of increasing operating income relative to the budgeted amount. All right, so let's talk about favorable for a moment. If our actual revenues are greater than our planned revenues, that's a good thing, right? Okay, so with revenues, actual that is higher than what we originally had planned is a favorable variance. Therefore, on the other hand, if our actual results in revenues are less than what we had planned, then that is what is called an unfavorable variance. Okay, so when we're talking about revenues, favorable variance means greater actual, and unfavorable means less actual than planned. Okay, so get the concept down for revenues before you flip the switch and consider favorable variance for cost and expenses. Cost and expenses. If our actual results are less than what we had planned, then that would be a favorable variance. Our costs and expenses are less. Yay, that's a good thing. Therefore, what if our actual results are more than what we had planned? That's a bad thing. That would be an unfavorable variance. Okay, so you've got to make sure that you're thinking through what is favorable and what is unfavorable based on what it is specifically you guys are looking at. Okay, so revenues are one thing, costs and expenses are something else. You can take and net your favorable and unfavorables together to get a net result. Okay, so consider your favorables as positive and your unfavorables as negatives. Net those results. If you get a resulting positive number, then your net is favorable. However, if you get a resulting negative net number, then that is unfavorable. Okay, so get those little concepts down before you dive into the remainder of Chapter 7 material. All right, so variances may start out at the very, very top with what's called a level 0 analysis, and we can dive in farther and farther and ask questions. How did we arrive at these variances? All right, because there may be people that we need to talk to so that we can try to head this stuff off as soon as possible using that management by exception. Again, we do not wait till the end of the period. We're going to continually be checking our budget to date versus our actual results to date so that we can try to do a good job of managing our operations. The level 0 analysis is nothing more than the difference between actual and static budget operating income. And we're going to see here in a few minutes that I can show you this on a chart that I have gone to the effort to make for you guys that I'm going to highly recommend that you print it out and also save yourself a copy. You may want to write some additional formulas on it or do whatever you would like. But it gives you a very good viewpoint as to how all of these variance analysis are linked together. And I will do a second video here in a few moments for you guys to go and pull up. All right, so we can take and ask the question, how much were we off? But what we want to really know is why were we off, okay? So levels 1, 2, and 3 take that level 0 and slice it into progressively more detailed levels of analysis. Where and why were we off? Those are the questions that we can answer with levels 1, 2, and 3. Level 0 tells the user very little other than how much operating income was off from budget. Okay, so this level 0 is basically us comparing apples to oranges. It is not giving us really the information that we need to better run the company. We had an example in Chapter 6 where we had originally planned to sell 12,000 units, but we actually ended up only selling 10,000 units. Okay, so level 0, apples to oranges, 12,000 units versus 10,000 units, a whole lot of the reason why there would be what is called a static budget variance between that master static budget that used 12,000 units and standard cost versus the actual results where 10,000 units were what were sold. Big difference there. Lots of different things going into why there is a static budget variance. So that's why we need to take and develop what's called a flexible budget, and we can go beyond the static budget variance to answer the questions, how were we off? Why were we off? Okay. Here is the level 1 analysis showing us the static budget variance. Okay, so back in chapter 6, we learned to formulate this third column on this example. All right, so this is our master static budget over here on the far right. I always want you guys to set your work up with the master static budget to the very, very far right and your actual results to the very, very far left. Now, what we see right here in the middle right now is called the static budget variances. We are going to see as we continue on with this variance analysis that we are sooner or later going to put another column here in the middle, and it is going to be called our flexible budget. And this is why I have developed this large map-like thing for you guys to take a look at so that you can see the big picture all together. All right, so here in a few minutes, make sure you watch the next video where I'm kind of talking you through what is showing up on this map of sorts. All right, so our static budget variance, notice that we have 12,000 units that we planned to sell. They were going to be sold for a specific dollar amount per unit to give us this $1,440,000 in revenues. We expected so much in direct materials to be used per unit, and that specific quantity was going to cost us a specific dollar amount, and we would have taken those numbers, multiplied them out, and then multiplied it against 12,000 units to give us what we planned or expected or budgeted for direct materials. We would do the same thing for direct manufacturing labor. X hours per unit times the number of units times so much per hour. That is our expected amount or budgeted amount per standard costing. This is what we're using in our costing mechanisms, is a specific dollar amount per unit based on the standard or allotted time for manufacturing and a standard rate per hour for that labor time. Also a standard quantity of materials per unit at a standard price per unit of direct materials times the number of units. We would do the same type of thing for our variable manufacturing overhead based on whatever our allocation rate is. Also adhering to our activity-based costing. And that's how we put our static budget together. Fixed cost, we would have an expected amount within a relevant range that these cost would be expected to be within that dollar amount. And notice that we've got our revenues minus our variable costs minus our fixed costs to give us the operating income planned or expected to be $108,000 for the period. Now, our actual results column is based on actual units at an actual dollar amount per unit for the revenue. So there could be a difference not only in quantity, but also in dollars per unit selling price. All right, so we're just going to fill in our actual results. So here's our actual revenues, and then here are our actual costs. Actual quantity in direct materials at their actual price, actual manufacturing at their actual labor hour, actual variable manufacturing overhead cost, and even our actual fixed cost would all get plotted in, and our operating income for the period would get calculated. This center column shows us the static budget variance, but we can break it down line item by line item. Okay, so again, we're not talking apples to oranges here. So we're going to take this information and go farther into it. And we need to find out, did we overpay for items? Were we inefficient in our quantity of direct materials used, etc., etc.? There are a lot of reasons why we could have some unfavorable or favorable static budget variance results. So let's look at our differences here. 12,000 budgeted units versus 10,000 actual. 10,000 actual units sold is 2,000 less than the static budget or the master static budget. 10,000 is 2,000 less. 2,000 less sold is unfavorable. Our revenues of $1,440,000 that we had planned versus our $1,250,000 actual. Our actual revenues in dollars is less than our master static planned or expected revenues. That's not good. Therefore, that difference of $190,000 is unfavorable. Our direct materials, we've got $720,000 expected on that master static budget, and our actual is $621,600. That's a difference of $98,400. It's a cost or an expense. This number is smaller than this number, therefore it is favorable. $192,000 versus $198,000. It's $6,000 difference. The actual is more expensive than the 192, so it's unfavorable. 144 versus 130,500. This one, the 130,500 is less than that by 13,500. It is less than. This is cheaper, therefore it's favorable. You guys can notice that we have got favorable, unfavorable, and favorable. These three get netted together to give us a variable cost total. Okay, so favorable, unfavorable, favorable, 105,900 favorable net. Okay, so if you need to pause the video, get a calculator out, and double check how that works. Again, this would be a positive number minus and a positive. And this is giving us the difference between 1056000 and 950,100. This is our netted number. Again, you can tell that this is cheaper by this much, therefore it's favorable. Okay, so either calculate it like this or net your numbers. We can calculate our contribution margin. You guys know that it's revenues minus variable cost for contribution margin. So we can see that our contribution margin is $1,250,000 minus the total variable cost to give us $299,900 versus the $384,000 over here. Therefore, this in contribution margin is less than 384. Contribution margin's a good thing. Contribution margin is what we have left over after all variable costs have been covered. That goes towards fixed cost and net income if we're lucky. So we like contribution margin. So $299,000 versus $384,000. This contribution margin is less than, therefore that means it's unfavorable by $84,100. And then finally here we've got our fixed cost. Our actual fixed costs were $285,000, which is $9,000 more expensive than what we had planned. Therefore, our result is unfavorable $9,000. All right, so what do we have overall? We planned to have $108,000 in operating income, but our actual result ended up being $14,900. If we compare those two final numbers, then we are unfavorable $93,100 in our static budget variance. Now we've got a lot of underlying things past this to go and take a look at, because there are a lot of reasons that we could total a static budget variance of $93,100 unfavorable. Lots of different things could be contributing to that unfavorable variance, and that's why we need to take this a step further and develop a flexible budget and do many more calculations and variance analysis in order to get to the bottom of it. All right, so I want to pause right here for just a second, and we are going to take a quick peek at this map that I have drawn out for you and see if I can't give you some additional information. Okay, here's this Word document that I have updated for you guys. It's called Hauns Variance Chart Advanced Managerial Budgeting, and I did it in a Word format. All of these variance headers are tested on the Certified Management Accountant exam, or otherwise known as the CMA exam. And this is why I have written this thing out, because I literally made one for myself while I was studying for part 1 of the CMA exam. So take a look here at what we have said thus far. We developed the master static budget in chapter 6, and that is what this far right hand column over here represents. We have just talked about our actual results. What were our actual revenues? What were our actual variable costs? What were our actual fixed costs? And we have compared those line item by line item and then tallied up what is called our static budget variance. Okay, so notice I've drawn this line and put here in the center static budget variance. What we want to do is take this and go further. We are next going to develop a third budget, and this one's called the flexible budget. The flexible budget is going to take the actual quantity from actual results. For example, 10,000 units, and then spell out what we would have expected our actual results to be if we flexed the master static budget for that quantity. All right, so instead of saying 12,000 units at $50 a piece equals so much in revenues, we're now going to say 10,000 units times $50 in revenues. All right, so we're going to use the actual quantity times the standard pricing, the standard inputs, the standard quantity allowed that we used in our planning when we put our master static budget together. All we're going to do is take those original revenues per unit, cost per unit, budgeted input per unit, and multiply it times 10,000 and calculate what we would expect to see had we used everything standard times the new quantity of 10,000. In doing this, we can then talk apples to apples, not apples to oranges. All right, once we have put this flexible budget together, we can then take it even further. We can calculate what is called the sales volume variance, which basically says what part of the static budget variance is just due to the change in volume regarding sales, and the flexible budget variance, and this is due in regards to things such as our inputs, our efficiency variance, and our price variance are in the flexible budget variance. Okay, so how much did we pay for our direct materials versus what we had originally planned? How much indirect materials and direct labor did we use versus what we had planned? Okay, these are the things that tweak out why we would have a flexible budget variance. Sales volume variance, just because of the change in the volume of the item we are selling. Marketing people hopefully are spending a little time on specifically our sales volume variance over here to the right. Notice that it is made up of the sales mix variance and the sales quantity variance. And the sales quantity variance can be broken down into market share variance. Okay, so for some reason our quantity was off because of a change in market share, and so much of it is because of a market size variance. Okay, so the market size was expected to be one thing, but it actually ended up being something else. Our market share was expected to be something, but the results were actually something else. And then notice that our efficiency variance can be broken down into our yield variance and our mix variance. So use this right here to take notes on, maybe write out some formulas. If you want to blow it up and put it on legal size copy paper instead of regular paper, that's fine too.